Most people spend more time picking their Netflix subscription than they do designing their life insurance portfolio. And ironically, one of those decisions could leave your family completely broke. Let's fix that right now. Because what we're about to unpack isn't just about death benefits, it's about building a financial architecture that works while you're alive and breathing. Life insurance has this reputation as the world's most boring purchase. But here's the quiet truth nobody at the dinner table is saying out loud. The wrong mix of coverage could cost you hundreds of thousands of dollars over your lifetime. Or worse, leave a gap so wide your family falls right through it. We're talking about a market worth over $3 trillion in the United States alone, with millions of people either drastically underinsured or paying for the wrong product entirely. The reason most portfolios get this wrong comes down to one fundamental misunderstanding. People treat life insurance like a single product when it's actually a spectrum of tools. Think of it like a toolbox where someone only ever grabs the hammer, even when they clearly need a wrench. On one end of that spectrum, you have term insurance, which is basically renting protection for a set period, cheap, clean, and powerful for covering peak financial obligations like a mortgage or young children. On the other end sits permanent insurance, the kind that never expires and can accumulate cash value over time, functioning more like a long-term financial vehicle than a simple safety net. Just a few years ago, the financial media was loudly championing buy term and invest the difference, as if it were gospel written in stone. And honestly, for a lot of people, it genuinely was solid advice. But the conversation has matured, and what we now understand is that a blended approach, layering term over a permanent base, gives you coverage that breathes and adjusts with your actual life. The psychological tension here is real. Term insurance feels responsible and frugal, while permanent insurance feels extravagant and confusing, and that emotional tug of war causes people to either over-index on cheap coverage or get sold an overbuilt whole life policy they can barely afford. We've all heard the cautionary tales from someone's uncle who paid into a policy for 20 years, surrendered it during a tough stretch, and walked away with almost nothing. Historically, insurance products have moved in generational cycles. Whole life dominated mid-century. Term exploded in the 1980s alongside the invest yourself movement. And universal life products of various flavors have been rising steadily since the 1990s. Each cycle felt like a revolution until it didn't. And what we keep relearning is that no single product is the hero. Context is always the hero. Here's a framework that actually holds up across those cycles. Anchor your coverage with a term policy sized to your largest, most time-sensitive obligations, think 10 to 20 times your income. Then layer a smaller permanent base underneath that's designed to stay in force forever, regardless of your health or wealth at age 70. 5. The term handles the urgent, heavy lifting. The permanent policy is the quiet foundation that never leaves. One of the biggest misconceptions is that permanent life insurance is inherently a bad deal, when in reality, the issue is almost always sizing and structure, not the product itself. A whole life or index universal life policy that's properly funded and appropriately sized can be an extraordinarily efficient tax-advantaged asset. The problem is that most people buy too much of it too soon before their term needs are fully covered. The actionable lesson from every financial cycle we've studied is this: lead with term to lock in insurability while you're young and healthy, and add permanent coverage deliberately and modestly, treating it as a complement rather than a replacement. Position size matters enormously here. A permanent policy that strains your monthly budget creates its own kind of financial risk, which completely defeats the purpose. Discipline means buying what you can sustain, not what sounds impressive. And the most sophisticated portfolio in the world collapses if you lapse a policy during a bad financial year. Process over conviction. Always review your coverage at every major life transition: a new child, a paid-off mortgage, a business partnership, a retirement milestone. Philosophically, the goal of this kind of portfolio isn't to win some actuarial game against an insurance company. It's to sleep well at night, knowing that no matter what unfolds, the people depending on you are covered, and the wealth you've built won't evaporate in a single catastrophic event. There's a quiet dignity in that kind of preparation that no stock pick or real estate deal can fully replicate. We're comfortable with any outcome here because the whole point of this strategy is that it doesn't require a perfect outcome. It requires a rational, consistent process that holds up under pressure, market swings, health changes, and the 1,000 unpredictable ways life decides to surprise you. That's not pessimism. That's the most optimistic financial move you can make. If this framing resonates with you and you're ready to stop guessing and start building, the next step is simply an honest conversation about where you are and what you actually need. Whether you're thinking about life insurance as part of a broader wealth strategy, getting into real estate investing, tackling a home contracting project, or finding the right lender to make your next move, check out our links in the description below and let's get you started.